Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be talking about what's been going on in markets this week, how things have been developing, what's been driving the moves. And I think the good place to start is probably with the US dollar. As you can see here, the US dollar index, the DXY, has it failed last week to break above the short-term bearish trend channel. It's now well and truly back within the bearish trend channel. It looks like it's about to test its lowest levels of the year so far, or actually today it reached a low of 100.846, and on the 2nd of February it reached a low of 100.82. So it's come very, very close to testing yearly lows, but to be honest, looking at this technical trend, the rejection of the 21-day moving average, the fact that we're still respecting this bearish trend channel, fundamentals, which I'll get to in a second, basically weaker than expected inflation data out of the US, which comes on the heels of other weaker than expected data releases as well, which we'll talk about. But everything's pointed to the dollar breaking lower potentially. And, importantly, we've already had euro dollar, which is the biggest constituent of the dollar index, pushed to its highest levels since last April. Actually, it might even be since last March. You've got sterling or cable, sorry, sterling, the exchange rate between the pound sterling and the US dollar, also pushing to its highest levels since last June. Dollar yen holding up a little bit better for now, because if we just look at what's happening in US government bond markets, actually holding within recent ranges for now, although I'm thinking we are going to be creeping lower in the coming months. And, we'll talk about the data and I'll talk about why I'm thinking that. But you can see the 10-year yield also hovering within recent ranges. But again, I think also going to be heading lower. With the dollar coming under pressure, um, yields sort of within recent ranges. You can see that stocks actually have just really remained quite range bound this week, which was kind of surprising, to be honest. Like, we've had some very important data releases, but the S&P 500 around 4,100 within recent ranges, like I said. The Nasdaq as well within recent ranges. If I can get the chart to load. Yeah, you can see it's just below 13,000 there, having swung between about 12,800 and 13,200, holding nicely above its 21-day moving average though, which is, in my opinion, a strong technical sign that the longer term positive trend is going to continue for now. We've got recent strong support at the 200-day moving average. We've got support at the 21-day moving average and around recent lows. I think we can crawl higher as long as the dollar keeps weakening and yields. I mean, if yields potentially fall to fresh lows. Dollar weakness is helping gold. Gold is just doing really well recently. Around $2,045 at the moment. It looks like it's going to test the double top all-time highs. Well, chart doesn't want to load any older data, but if you go back to 2020 and there we go. If you go back to 2020 and 2022, you can see there's like a double top around the all-time highs around 2070. If the dollar keeps weakening, if US yields keep going lower, as we price in an increased likelihood of a US recession later this year and of rate cuts from the Federal Reserve, it just seems like this gold is going to keep moving higher. It's got to. Oil as well, enjoying the weaker dollar. It's trying, it did in the last couple of days push above this recent range that it had been in. Remember that jump was triggered by the surprise OPEC output cut. But this 82 to sort of 83 resistance zone is big. 200-day moving average, support term resistance going all the way back to last October. And we do have pessimism growing about US economic growth. US obviously a key market for oil. A lot of demand headwinds still there. But if we can break above this area, we're potentially in for a swift move higher to this double top. So just trade what you see with oil, I think. If we do get a convincing break above this area, then we can definitely go. back into the 90s, which, by the way, not good for the US inflation outlook and for hopes that the Fed would be cutting interest rates later this year, which fear that higher oil prices might do that, might create a less favorable macro outlook, might be something that prevents higher oil prices. So, yeah. But anyway, I said we're going to go through the fundamentals in more detail. So let's look at the calendar here because the main thing this week has been US data. You can see the headline CPI numbers that we got on Wednesday, weaker than expected. We dropped from 6 to 5%. That's a big drop. Partially because of base effects, because last March, we had a spike in inflation pressures because of Russia's invasion of Ukraine. But month over month, that was weaker too, 0.1. The core was still quite robust. It was at 0.4%, and I think year over year was at 5.6% still. But things moving in the right direction. That's the same message we got from today's PPI data as well. Surprise deflation actually of the producer price index. Month over month down 0.5. Core month over month down 0.1. What else have we had this week? We had the Fed minutes, which are kind of out of date because that meeting occurred before bank troubles, basically. Oh no, sorry, that meeting occurred after bank troubles. But pretty much as expected there, market's still thinking about potentially one more rate hike, then a pause, then potentially interest rate cuts later in the year. Some people talking about today's weaker than expected unemployment claims, which rose to 239K in the week just gone. But, that's still consistent with a healthy labour market. Labour market in the US could be showing some early signs of cracking, as we saw last week from the JOLTS job openings number. This is last week's data falling to a 2-year low, showing labour demand is starting to crack. But then the Friday jobs report we had last week was still pretty strong. So you're seeing signs of weakness in activity, ISM manufacturing and ISM services PMI in the US. And it might be a bit more of a lag before that filters into labour market weakness, but that labour market weakness probably is coming soon. But anyway, we're more focused on weakness in economic activity and potentially weakness in the consumer, and the consumer will be very much in focus tomorrow. We've got retail sales data coming out of the US and preliminary University of Michigan consumer sentiment data as well as some Fed speak. But yeah, that's pretty much everything that's going on at the moment, guys. What we need to be looking out for the rest of the week. Hope you all found this video informative and useful, and I will see you all in the next one.